Hi, this is Julia M. Spencer. I'm a real estate advisor, investor, and your #1 source for real estate advice online. I'm filming here from the beautiful city of Trier, Germany, and this video is about segregating certain assets away from the rest of your real estate in order to accelerate your depreciation expenses on your taxes. How do you do that? I actually meant to make this video up a long time ago. I had a request from a subscriber and I've never gotten to it, and I just remembered it, so I thought, hey, this is a good place to do it while I'm on vacation. So right here we are actually in the city of Trier, Germany, and this behind me is a monument that was built. It's called Turm Luxembourg. It's made completely out of metal, the whole entire thing, so it's kind of cool. We're going to go up now and check it out. And it gives you a really cool view, actually, as you can see. So real estate is depreciated over 27, I think it's 27 and a half years, I'm not sure exactly the number. But you basically take what you paid for the real estate minus the land, obviously, and you depreciate the building over that many years. You basically divide the price that you paid for that property minus the land and divide that over those years, and that's your depreciation expense. Now you don't need to figure this out in your head, because if you use something like TurboTax or some other tax software, it'll do that automatically, so you don't need to worry about it. But the point is, that's a really long time frame, so you're not going to get a whole lot every year. You're going to get just a small portion every year that you can depreciate. So what you can do is you can take different assets away from that real estate and classify them separately according to their asset class and depreciate them faster. For example, let me just give you one brief example, and you can think of more examples as you go. But basically, if you have a fridge in that rental property, real estate that you use as a rental property, and let's say a stove, maybe you put in a new roof or something, or you just add stuff to the house. Appliances, it could be appliances, it could be a remodeling job or something, or a whirlpool or something. Anything that's part of the real estate, you can break that out. Also, if it's a rental real estate, obviously the furniture, basically if you purchase a piece of real estate that's already furnished, you can, on paper, take away all these pieces that are associated with that real estate, such as your couches, your TV, any kind of bedding or beds, dishes, all that stuff, and you can allocate that on your tax return separately as part of your business, as assets of your business associated with that property, but not depreciated as the entire thing. So then you can basically take those pieces, like furniture for example, depreciates for maybe 5 or 6 years or maybe 10 years. Also, electronics such as a TV, or maybe you have some sound equipment in there, speaker system, whatever, security system, all those things, they have less years after which that they're fully depreciated. So you can break all these pieces out and depreciate them separately from the entire big real estate, which has a lot of years on it to depreciate, and you can depreciate them faster. Now the one thing that you need to remember, if you segregate different assets from real estate that depreciate faster, that doesn't mean you're going to get more depreciation expenses. It just means that you get them faster, and that's a really good idea if you don't plan to hold on to the real estate very long. But also, it's actually a lot of times it's not really worth it, because you have to have an inventory, and in the inventory you're going to have very market values of all those assets, either by receipts for how much you paid for them, or by fair market value as you can determine it. So for example, if you bought a condo that's already furnished and you want to break out all the furniture in there, you're going to have to find that particular furniture or like furniture in a catalog or online, and you basically have to document each piece of real estate to see how much it is worth when you purchase the whole entire thing as a set, and then you have to start at those dates. Also, if you prepare your taxes on your own, this is actually a lot of work, because you have to basically have a line item for each property where you just basically enter, okay, this is $100, furniture $1,000, mattresses $500, all those things, you know. It just takes a lot of time, and you need an accountant or a good bookkeeper to do this, which will cost money, which kind of defeats the purpose of even doing it. So unless you're doing this on a really big scale, like you're a hotel business or something, segregating different assets for faster depreciation on taxes isn't really worth it. It's never been worth it for me. So whenever I purchase a property that's already furnished, I just incorporate everything that's already in there as part of that property. Now in the future then, if I purchase additional items such as a replace fridge, for example, then I go ahead and segregate that as a separate item and just do that one at a time as I purchase them. So it's not so much work and I can do it myself. So I hope this makes sense. Hopefully this video is not too windy. And for more tips like this, go to my website today. It's juliamspencer.com. It's at the bottom of this video. Subscribe to my newsletter. I just published a brand new audiobook on tax sale foreclosures that you can download today. I'm also working on the second version of this, so you want to stay up to date with this. Make sure you subscribe, and I look forward to hear from you. Julia M. Spencer. Go to my website today. Thank you.
For your free guide to real estate investing, visit juliamspencer.com.